My next guest continues to believe the Fed is making one policy mistake after another and will be forced to stop tightening and even start cutting interest rates mid-year. He says the 10-year yield has peaked. Bonds are a buy here. Joining me now is Sri Kumar. He is president of Sri Kumar Global Strategies. It's great to see you, Sri. So lay it all out here.
Good morning. Happy New Year, Kelly.
Happy New Year. And maybe you heard part of what Chris Grisanti said. He shares a similar view. He thinks they will have to quickly pivot once they see corporate earnings start to drop. What do you think?
I think when corporate earnings drop, when unemployment goes up, or when the strong dollar turns out to be a big hit on U.S. companies, any one of those can do it, Kelly. Most importantly, 2023, we are entering the election campaign year. Right now, there is the election of the House Speaker going on right now. All of this is going to have a major impact on what the Fed is going to do. Powell has already got a lot of criticism for his actions from senators and representatives, and I don't think he and his colleagues can continue with rate increases much further. It has nothing to do with economic policy. It doesn't have so much to do with inflation, which will remain higher than projected, but yet he will stop increasing, maybe cut interest rates for the simple reason it's a politically more appropriate thing to do.
Okay, politically more appropriate. Let's boil this down to what investors should do. I mean, do you agree that people can kind of start dabbling a little bit in stocks now, Sri? What about bonds? It sounds like you see a slowing economy could make them a buy here as well.
Until let's take it in 2 or 3 steps, Kelly. Until recently, both equities and fixed income were a bad buy. Because of stagflation, equity prices came down and bond yields went up, so you could not find relief in either asset class. So right now, the change that has taken place is that bond yields have peaked first and equity prices have not bottomed yet. With the result, you have a little bit of elbow room, you have ability to rest in bonds, and I think that's going to be good for the next few months. Also, look at alternative assets. Look at opportunities to invest over the next 5 years. I've talked about globally diversified real estate as a way to put your money into and not worry about the immediate impact on equities. But equities in the short term are going to take a hit, and I can't see any way that you can get relief from that.
So you say, I mean, when you say a hit, how much further do you think they are we talking about? And what makes you so certain?
2 or 3 things. One, I've been saying for a long time, we are headed to stagflation. So what's going on now is not at all surprising. It is exactly the path which the Fed has led us to. They misjudged inflation, and now they are overdoing the tightening, and together they are causing a recession. So that's why I feel so certain. Timing. Look at the bond market, the yield curve from 2 years to 10 years, as well as 3 months to 10 years, have become very inverted. The 2 to 10 inverted in early July, and it inverted to minus 84 basis points in November. And that's the most we have had, Kelly, since the early 1980s.
Sure.
We didn't have that kind of an inversion even in 2006, 2007, ahead of the 2008 crisis. That tells me that the recession is coming about the middle of 2023. A related issue, the yield curve, both the 2 to 10 and as well as the 3 month to 10 year, have started steepening in the last 2 weeks.
We just showed that, yep.
And that steepening in turn suggests that the bond market is anticipating a recovery after the recession. The bond market is far ahead. Even before the recession begins, it anticipates a recovery.
Quick final question, and I know there's people at home just sort of banging their heads on the table going, great, I guess I can buy bonds, but this all sounds pretty horrible.